Collapse file number 3. Subject: Archegos Capital Management. Assets under management: $36 billion. Market exposure: more than $160 billion. Public filings on record: none. Cause of death: a fortune so well hidden that the man holding it became invisible until the day the market could finally see him. This is the Collapse Files. In late March of 2021, a single investor lost as much as $20 billion in about 2 days. It may be the fastest destruction of personal wealth in human history. And here is the strange part. Until the moment it happened, almost no one on Wall Street had ever heard his name. His name was Bill Hwang. He drove a modest car, gave away enormous sums to his church, and lived nothing like a man who could move the price of America's largest companies with a phone call. But he could, and he did. To understand Hwang, you have to understand his teacher. In the 1990s, he worked for Julian Robertson, the legendary head of Tiger Management, one of the most famous hedge funds on earth. Hwang was a so-called tiger cub, and Robertson personally backed him to start his own fund. He was anointed. But here is the first thing the file flags, because it came in writing years early. In 2012, Hwang's fund Tiger Asia pleaded guilty to insider trading in Chinese bank stocks. He paid a settlement of $44 million. Hong Kong banned him from its markets. He was, on paper, a convicted insider trader. The warning was filed, and the money kept flowing. In 2013, Hwang reinvented himself. He returned the outside investors and rebuilt his operation as something called a family office, Archegos. And that word, family office, is the whole story, because a family office manages only one person's money, and a firm that manages only one person's money is barely regulated at all. No outside clients meant no investor disclosures, no public reporting of who he was or what he owned. He started with around $10 billion of his own wealth, and then, very quietly, he found a way to turn that $10 billion into the buying power of a small nation. The weapon was an instrument called a total return swap. It works like this. Instead of buying a stock himself, Hwang had a bank buy it. The bank's name went on the share register, but under a private contract, Hwang collected all the gains and absorbed all the losses. He owned the outcome. He did not legally own the shares. And that is this file's first twist. Total return swaps made Bill Hwang invisible. He could hold the economic equivalent of an enormous stake in a public company and never appear on a single ownership record. The bank showed up as the shareholder. The man pulling the strings showed up nowhere. He did this at not one bank, but many: Credit Suisse, Nomura, Morgan Stanley, Goldman Sachs, UBS. And here was the genius and the poison of it. Each bank could see only the slice of him that it held. Not one of them could see the whole. Together, they lent him enough to build more than $160 billion of market exposure, on a base of perhaps 10 to 30. And he did not spread it around. He poured it into a handful of names: ViacomCBS, Discovery, the education company GSX, Baidu, Tencent Music. A concentrated, leveraged bet on a few stocks, financed by banks who each thought they were one of many small lenders, not joint funders of the largest hidden position on the market. It became a machine. Hwang bought, which pushed the prices up. Higher prices made his existing positions worth more. That extra value became collateral, which let him borrow more, which he used to buy more, which pushed prices up again. Round and round. A perpetual motion machine for as long as the prices only went up. By early 2021, through these swaps, Bill Hwang was effectively one of the largest shareholders in several major American companies. He had the power of a corporate giant. And the investing public, the regulators, the other shareholders, the companies themselves, had no idea he existed. Which brings us to Exhibit C. And Exhibit C is a document that was never filed. In American markets, there is a rule, Schedule 13D, cross 5% ownership of public company, and you must tell the world within 10 days who you are, how much you hold. It exists so that no one can secretly control a company in the dark. Archegos crossed that line again and again. The number of 13D filings it submitted was 0. The swap was engineered around this single rule. The blank form is the evidence. The crack appeared on March the 22nd, 2021. ViacomCBS, one of Hwang's biggest positions, a stock he had helped inflate, announced it would sell $3 billion of new shares. A routine move, but the market read it as a signal. Even the company thought its stock had run too high. ViacomCBS slipped. Then it fell harder, and the machine that ran so beautifully upward now ran in reverse. Falling prices meant Hwang's collateral was worth less. Worth less meant the banks wanted more cash to cover the loans. The banks issued margin calls, and Bill Hwang did not have the cash. Tuesday, Wednesday, the calls grew louder. By Thursday, March the 25th, the prime brokers were making a discovery that ran cold down their spines. The huge, unexplained margin calls landing on each of their desks were all coming from the same man, and the positions were enormous. That Thursday night, the banks did something sensible. They got on a call together, and they tried to agree on a plan, an orderly, coordinated unwind, selling Hwang's vast positions slowly so they wouldn't crash the prices and harm everyone at once. For a few hours, civilization held. Then it broke. Whoever sold first would get the best prices and escape. Whoever waited would be left holding the wreckage. By Friday morning, Goldman Sachs and Morgan Stanley broke ranks and began dumping billions of dollars of stock in giant block trades before most of America had finished breakfast. It became a stampede. Roughly $20 billion worth of stock changed hands in a single fire sale. The prices of Hwang's beloved companies collapsed under the weight of their own forced selling. The banks that moved fastest got out. The banks that hesitated did not. When the dust settled, the tally for the banks was brutal. Credit Suisse, slow and overexposed, lost more than $5.5 billion, the single biggest hit. Nomura of Japan lost around $2 billion. Morgan Stanley and UBS were bruised. Goldman, who ran first, walked away nearly clean. Collective damage, around $10 billion. And Bill Hwang himself, a fortune that may have peaked near $30 billion, gone. As much as $20 billion of it evaporated in roughly 2 days. He did not sell at the top. He rode the machine all the way up and all the way back down to nothing. Now hear the echo from the other files. At Knight Capital, the warnings sat in 97 unread emails. At Barings, an audit named the danger a full year early and was ignored. Here the disease evolved. The warnings weren't ignored, they were structurally impossible to see. Every bank had risk limits. Every system had alarms. But no single watcher could ever see the whole $160 billion shape of him. Credit Suisse commissioned an autopsy of its own role. The report's verdict was withering. It described a failure of risk management, in its words, of staggering proportions. The bank had let one secret client borrow enough to inflict a multi-billion-dollar wound, and that wound did not heal. Here is the tally's final twist. Archegos was one of 2 body blows. The other was a firm called Greensill that landed on Credit Suisse in the same disastrous year. The bank never recovered its footing. In 2023, Credit Suisse, founded in 1856, 167 years old, was swallowed by its rival UBS in an emergency rescue. Another ancient bank killed in part by a single hidden client. An echo of Barings. 2 collapse files apart. This time the law came. The Department of Justice and the SEC charged Hwang with fraud and market manipulation, arguing he had lied to his banks about the size and concentration of his positions to keep the loans flowing. In July of 2024, a Manhattan jury convicted him on 10 counts. His chief financial officer was convicted too. On November the 20th, 2024, the man who once commanded the buying power of $160 billion was sentenced to 18 years in federal prison. Prosecutors had asked for 21. The judge settled on 18. The invisible man would spend most of the rest of his life very much accounted for. And this is what makes file number 3 different. Bill Hwang did not break into a vault. He did not forge a fax. He found a blind spot built into the market itself, a structure where you could control a fortune and legally owe the world no explanation at all. The hole was in the rules. He simply walked through it. A fortune nobody saw, built on a filing nobody made, undone in a weekend nobody could stop. $160 billion, and not a single name on a single form. File number 3 is closed.